In this video, we'll talk about risk, volatility, and why I believe risk is relative. See, countless Canadians aspire to invest but don't yet do so. There's a lot of reasons for this, but chief among them is the fear of investing, with lack of understanding surely helping fuel that fear. So in this video, we use research and market data that goes as far back as the 1900s to help you redefine risk based on your goals. This is episode 9 of 30 of our 2021 Money School. Hey, I'm Hervin Pesa. I'm a financial planner, but just like you, I'm still on this journey to building wealth and financial independence. This channel aims to provide you money lessons we all wish we got from school. So to sprint towards this mission, in September, we're publishing a video every single day. So be sure to subscribe and hit the bell so you don't miss any of the lessons. What do you think of when you hear of the word risk? Do you think lions, tigers, getting hit by a car as you cross the street? How about getting bit by a shark? See, we instinctively think of scary stuff. Cognitively, we're wired to run from fear more than we would run towards pleasure. This is known as loss aversion. The prospect of protection is stronger for most of us compared to the dreams of gains. We would do way more to protect our balances compared to what we would do to see it grow. We just don't like uncertainty. When looking at risk, most of us think of risk as the portfolio balance going down. And I believe that's a fairly crappy definition. See, money, our assets, the wealth that we want to build, these are all tools, vehicles that will help us get to our end goal. So the risk I prioritize for my clients is the risk of missing the goal, the risk of not having enough for what we want when we want it. And then that dictates our investing strategies, our actions, and of course our asset allocation. See, I'm not a portfolio manager, but I have to help my clients create strategies that will get them to their goal. And I believe that risk is relative to the goal. There are many underlying factors beyond this, but this is what it boils down to. Will I have enough money to buy the thing I want when I want it? That holds true whether what you're trying to get is a cup of coffee from Starbucks this Sunday, or your dream retirement, or maybe you want to afford buying your heirs a better future by giving them a significant financial head start. Let's say that you have your regular Sunday morning routine and you want to buy coffee from Starbucks. Would you invest the $10 you have in your pocket for the prospect of making it $12 by then? Of course you wouldn't do that, because there's a chance that your account will be less than the $10 you need. There's a likelihood that it might be worth $6. And then you'd have to give up the whipped cream and the vanilla pumps, thereby missing your goal. So the wise move would have just been to keep the $10 in your pocket. See, investing it is silly because if you're right, you'll have to be so right to make it worthwhile. And even if you were, your goal was not to buy a second cup of coffee, so there's no point and no reason to invest beyond this. So for that short time frame, keeping it in cash makes the most sense, right? On the other hand, there's the opposite extreme. If you just keep your cash in your pocket, it'll likely be insufficient to pay for the same cup of coffee 10 years from now, let alone in 30 years. The cash you hold in currency will lose value continuously. I use these two extreme examples from end to end to highlight the kinds of risks that we have to focus on. Volatility in the short term and inflation in the long term. Here's the problem. The only assets that have real return, those that have outpaced inflation, come with volatility. What is volatility? Volatility is the financial stand-in or the mathematical stand-in for risk. It's usually stated in variance or standard deviation, and the formula for both are equally ugly. So let me give you a visual instead, and let's explain what it's really trying to measure. Imagine that I'm playing darts against a professional dart player. Yeah, me, Mr. Semi-Coordinated. We both have the same target, which is the bullseye, and we both get 10 tries. Between the two of us, it's very likely that he will land his dots in a smaller perimeter around the target. If we were given 10 more tries, it's gonna be easier for us to predict where his shots are gonna land because it's in a tighter band. Volatility uses the average as the bullseye. How far away the shots deviate or the returns deviate from the target allows us to compare between multiple investments. The wider the range, the more volatile. So what does this mean for you, and what does this have to do with risk? Remember that in finance, risk is about predictability of outcomes. The wider the range, the more uncertainty, therefore the higher the risk. We look at smaller numbers expressed in percentages. It's really useful when you compare two or alternative investment options with similar returns because averages tend to lie. Consider these two investments. Both have a 7% annual return over the last 10 years. If you only relied on that information and then the average, it'll be a coin toss. But what if I showed you these return graphs? You can see that the range of outcomes for portfolio 1 vary greatly, with a low of -25% and a high of +30. Portfolio 1 has a standard deviation of 17.35, while portfolio 2 has a 4.62 deviation, or volatility. You would choose portfolio number 2 in this case. So volatility helps us identify risk. But I have to draw the line in the sand somewhere. Risk is not the same as volatility. If you take nothing else from this video, that they're not the same thing. Remember that risk is not the same as volatility. Volatility is a useful measure. It helps us make decisions between investment choices that would help us meet our goals. It's a useful tool, but that's it. Volatility is only a risk in the short term. Remember that cup of coffee? There's no reason for you to invest so that you can buy it in a few days. So how come I say low volatility doesn't equal low risk? Well, we have to look at how an event would cause us to fail from our financial goal. Example, if we are planning for retirement, the risk should focus on being unable to retire and afford the things we want at the time we need it for a long enough period of time. I know that sounds confusing, so let's go back to our case studies. In our second video, we met Samantha and Vicky, and based on the assumptions we've built in that case, for them to have the lifestyle they want in the retirement time frame they want, they need to have accumulated about $1.3 million, starting from the $180,000 that they already have set aside right now. We also figured that they're willing to invest a little bit more, potentially even $925 every month compared to the $400 that they're putting aside right now. For them, the risk of failing is when it comes to not having enough for them to retire. That's their biggest concern. It's not the ups and downs of the markets over the 25-year period that they have to go through. Are safer portfolios or low-risk investments really safer for our goal achievement? Well, let's pretend that we only have 4 portfolios to choose from. 100% cash, 100% bonds, 100% equity, and then a balanced 60-40 Canadian-focused portfolio. I have data going all the way back to 1935 to aid us in this research. The annual standard deviation or volatility, our stand-in for risk for the portfolios, is as follows. 4% for cash, 7% for bonds, 17% for the purely equity portfolio, and 11% for the balanced fund. If all we looked at was volatility, cash and bonds surely look more appealing. But what about actually hitting our goal? If volatility is all we looked at, cash is the safest, but does that hold true when we look at the big picture? Now, it's important for you to understand how I set up this comparison and just this bit of research. See, I haven't lived long enough and haven't experienced enough market changes to intuitively just understand how different factors and changes in the market and investment performance can affect a goal. For that, we have to look at history. We have to look at rolling periods that matches our goal. A rolling rate compares month-over-month returns over a full period. In our case, 25 years, because that's how long Samantha and Vicky have to get to retirement. So in our case, January 1935 will roll all the way until January of 1960, and then February 1935 will roll all the way until February 1960, and March 1935 will roll all the way to March 1960. You get the point. Those are only 3 periods, and we do that again and again, and over the time frame that we have historically until the time of this recording, there are 739 different 25-year periods. So put another way, Vicky and Samantha will have 25 years before getting to retirement, so we'll backtest our choices based on 739 attempts in history, take into account interest rate changes, world wars, recessions, and those already include the results of the post-pandemic market, the 25-year run from 1996 July to July of 2021. With that, we'll also apply a 1.5% total expense ratio on all portfolios to keep it fair, and we'll also assume that they're invested in a tax-sheltered account so we don't have to worry about the taxes as it's growing, and then the balanced portfolio will be rebalanced annually. Now let's look at the results. Cash had a success rate of 42% in all of our attempts. So it means it failed 58% of the time. Roughly 430 attempts did not succeed. Bonds was slightly better, had a success rate of 55%, but that's still unsafe. The balanced account had a success rate of 98%, and the Canadian Composite Index had a 99% success rate. The least volatile option, which is cash, virtually guaranteed failure. See, safety and riskiness have to be put in context that makes sense to our overall goal. We often hear high risk, high reward, but that's not always the case. In this situation, let's look at this comparison between the pure equity portfolio and the balanced fund. If I look at it, is it worth the risk? Is it worth switching to the higher risk option, in this case, the pure equity portfolio, just to squeeze out an additional 1% in success rates in the past? Again, I'm not saying this is gonna happen in the future, but we have to look at this analytically from what's occurred in the past, right? And the 98% or even the 90% gives me reasonable certainty that I can proceed with the plan and I can make adjustments along the way. So if both of these success rates give me enough confidence to meet the goal, then I can go back to volatility. Why would I go from the 11% volatility to the 17% volatility? Again, this is all relative and it's all perspective, right? That's why I discuss it. And I don't even construct portfolios for my clients. We use a third party for that. However, I need to be able to prepare them and understand why things are invested the way they are. More often than not, it's explaining why diversification is important and why understanding history is important when it comes to creating a plan that projects to the future. So time's on your side. I mean, short term, we really need to be aware of volatility, and we'll likely be better off avoiding it altogether and avoiding market-based investments altogether if we have short-term goals like major purchases. Maybe you want to buy a house in 2 years or a business in 5 years. You get the point. However, as I showed you earlier, removing it means guaranteeing long-term failure. We can't do without market-based returns. Allocating portions of your portfolio to what seems like highly volatile and unpredictable investments might be scary, but here's the good news. Long-term, the averages are on your side. Time is on your side. Remember that investing, especially for retirement, is a long-term endeavor. Remember that volatility is a measure of dispersion. So let's see what it looks like from a long-term perspective. This chart you see on the screen is from the 2021 Credit Suisse Global Investment Returns Yearbook. It shows annualized real returns, meaning returns less inflation in the US equity market, going from 1900 all the way to 2021. It looks at holding periods between 10 years to the full data set, which is 121 years. The light green color you see under the median represents the bottom quartile of all the results. This shows that over a 10-year holding period, 75% of the rolling returns over that 10-year period is above zero. Holding periods over 16 years showed no losses. So for the average investor, this needs to be something we remember. However, for the normal humans like me, 10 years is an eternity, even if I know retirement is 2 or 3 decades away. Thankfully, there are other methods that we can employ to reduce volatility. One of them being diversification. We already touched on that slightly when we compared the pure equity portfolio to the balanced portfolio. We'll dive deeper into diversification and asset allocation in a few days. But in tomorrow's video, I'll answer a really big question. Can my investments go to zero? Until then, stay aware, take control. I love y'all. Bye. Watch yesterday's video and be sure to subscribe. See you tomorrow.